welcome to our weekly look ahead at the markets, and just a quick recap on what's been going on over the last week or so. Really a tale of two halves for the stock market at least. We saw US inflation, the CPI number was lower than anticipated for a second month, so that's seeing some signs of disinflation, so a slowing in the rate of price growth. That was optimistic for the market. But then we got hawkishness from central banks. First, the Fed, which raised rates by 50 basis points. Now that was a slowing in the pace. It's been going at 75 basis points for several months now. And that slowing was noteworthy, but equally noteworthy and perhaps much more important is the destination. So rather than the pace and the timing of what the Fed's doing, it's more about where it's going to get to. And really we got, I think, a message from Jerome Powell that said we're going to be in this for the long haul, and it's going to be higher for longer, and the terminal rate is probably going to be above where markets currently expect. So I think that was the message from the Fed. The Bank of England also raised rates by 50 basis points. It also removed a line in the statement from last time around, in which it said that markets were pricing in too high a terminal rate. So that suggests maybe they are going to go for a bit more, for longer. They're facing very high inflation in the UK, plus 10% at the moment. And although the Bank of England thinks it's peaked, it's still got a battle on its hands and a deteriorating economic outlook. Retail sales in the UK on Friday were very weak as consumers' confidence remains at rock bottom, all-time lows. Meanwhile, the ECB donned its hawkish cap. And we got a message that very much that they're going to be hiking for a while yet. They raised rates by 50 basis points, but Christine Lagarde in a press conference indicated that there could be at least 100 basis points more by March, going at 50 basis points for each meeting. So that was a clear message of intent there. We've seen the markets revise up their terminal rate expectations, so had been around 3%, now seen at least 3.25%, potentially even 3.5%. So the market adjusting to that hawkish message from the ECB, and that sort of combination of factors was weighing on risk appetite. Also, economic data last week was not great. US retail sales fell by the most in a year. Chinese retail sales, industrial production numbers also pretty soft. PMIs towards the end of the week still signaling sluggish growth, so they're still in contraction territory in the Eurozone in particular. So it's a tough economic outlook, and the central banks are still hiking rates and say that they're going to keep doing that, even if they're not going to do it at the pace at which they've been going for all this time. So coming up to this coming week, we've got the Bank of Japan. It won't be doing anything like raising rates because that's just not what it does at the moment. It'll be sticking to its yield curve control range. But there could be some sort of update or announcement or some commentary about potentially the Bank of Japan reviewing its mandate sometime next year. That could have implications for assessments of where Japanese bonds are going to go, and therefore what the yen might do. Haruhiko Kuroda, the governor, is due to end his second term in April. So that could be the moment when they reassess the mandate and reassess their policy. So we will be looking for signs on that. US consumer confidence figures also out. They remain pretty low. That will be something to watch out for. Not a lot coming up in this week, last week before Christmas. But the big one on Friday is the US PCE inflation index. That's the core PCE index, which is the Fed's preferred gauge of inflation. Now that last time I also, like the CPI numbers, just showing signs of disinflation. So the markets will be watching that one to see if there's any further disinflationary trends. That could be a catalyst for the market. And I think maybe it's going to be tough trading up until that, because the market's going to be waiting to see what that number looks like. We've also had the triple witching on Friday, just gone for US stock index options and so on, and that could provide a catalyst for a reset in positioning that spurs the market to break out of this range it's been trading in. The S&P 500 has been trading in a range of about 100 points either side of 4,000 for several weeks now. This $4 trillion in options expiries on Friday, that is the sort of thing that allows a positioning reset, which could see a break in either direction. It's unclear which way, of course, but seasonality is a factor here, and the market does like to rally into that year end. That's it for now. We wish you a very happy Christmas and all the best for the new year. Thanks for watching.